Okay, well, we're still trying to finish up that first step, correct? First step of the audit is to compare each material asset and liability account with an outside source. We've looked at the asset side. Let's look at the liability side for a moment, okay? Accounts payable. What's our outside source? The statements we receive from our vendors, correct? And we're going to compare the statements we receive against our accounts payable subsidiary ledger, right? And if they're the same, then we're going to pay them. Same thing that we're expecting our customers to do for us. That's, again, paralleling. What's our outside source, do you think, for flooring payable? Is that a material account? Yeah, it's significant. Yeah. What's our outside source? The bank. The bank. Because the bank, do you think the bank is keeping track of how much we owe them? And they're keeping track of it by serial number, okay? Yeah, because they're charging us interest. And every month they're going to send us a list of all the motorcycles, in this case, that are floored that we haven't paid off yet. So we should be able to compare our list against their list, correct? What do we call that when we do that? Paralleling. And we make sure. Now, there might be some timing differences because we might have written a check on the 31st of January that they haven't recorded yet and taken off their list. So we'll have to do that, okay? What about sales tax payable? What's our outside source? Don't have one, except for at the end of the quarter. Now, at the end of the quarter, that's when usually we prepare the sales tax report to the state and tell them how much we owe, right? And if our sales tax report says that we owe $1,000 at the end of the first quarter, how much should our books say that we owe? $1,000. Does that seem too difficult to understand? I don't understand, though, why I go into companies and I look at their sales tax report and I look at their books, and sometimes they are materially different, I mean significantly different, and I ask them why, and they say, were they supposed to be the same? Okay? And very often what we find out is that they never adjust the sales tax rate in their cash register. Okay? Now, if they don't collect enough sales tax, can they just send a letter to the state saying, I'm sorry, please accept our meager offering here? No, the state requires that they pay them regardless if they collect it or not, don't they? Okay? So it's a good idea to keep the sales tax rate correct, but that's very often why they're not showing the same number there. And so if you see that discrepancy, check the cash registers first, okay? Now, that's for the end of the quarter. However, during the quarter, there's other months that we might be preparing balance sheets, and it will say a sales tax amount, correct? And at the end of each month, should we just ignore it and hope it's right? What do? When we don't know, when we don't have an outside source, we look for reasonability. Is it reasonable? Okay? Now, how would you check to see if sales tax payable is reasonable or not?
Compared to the sales.
Compared to the sales. Just take the sales for that month. Look to see, look at the sales tax rate, multiply it, and see if sales tax payable went up by about the right amount. If your sales were $10,000, your sales tax rate is 6%, that means that your sales tax payable should go up by about $600. Now, it may be off a little bit here and there, depending upon if it's out-of-state sales or whatever, but it should be in the ballpark, shouldn't it? If it's in the ballpark, then you're all right. But what if it went up? What if it went down by $200? It's a problem. Go back and find out. Fix it. You'll probably fix some other account too in the process. Okay? Okay, so that's our assets, our liabilities. We also look at long-term liabilities. If we have a business loan, a long-term business loan, what's our outside source? The bank. Okay? And the bank gives us an amortization schedule that shows us after each payment what our balance should be on that loan. We need to compare to make sure that our books reflect what the bank reflects. If it doesn't, either the bank's wrong or we're wrong, we need to figure out which one. Okay? So always look at some outside source. Now this works because of the accounting equation. Anybody remember what the accounting equation is? Assets equals liabilities plus capital. Have you ever proven that? You've done it every time you prepared a balance sheet, haven't you? And if those two numbers weren't equal, what did that tell you? You had a problem. You had to go back and fix it. You had to work late that night to find out why you were off, okay? Well, if we've checked the assets and we feel reasonably certain that within material grounds those are correct, and we've done the same thing for liabilities, what do we know about capital? It's right. It's got to be right. If our assets say $30,000 and our liabilities say $20,000, what's our capital going to say? $10,000. And if we've checked this number and they're correct, what do we know about that number? It's got to be right. Beauty of the accounting equation.